Okay, Kale again. This is typically the portion of the annual meeting where we talk about our sort of macro observations, where the market is probably going to be heading, what's going on in the economic sense to be aware of. Um, and, by talk about our macro thoughts, essentially mean we tell you that we don't pay much attention to them. Neither Loretta nor I really give a whole lot of credence to economic forecasts in general. I think the guidance of Peter Lynch here from 20, 30 years ago is still probably pretty accurate, at least for us. Um, we simply don't, we're not in the forecasting business, and we don't spend a ton of time talking about our expectations really on the macro front at all. Again, it's not because it's unimportant, it's just because it's so difficult to actually get any sort of macro forecast correct that it's just well past the point of usefulness in terms of any sort of analysis that either one of us do on a daily basis, frankly. Um, Nonetheless, we still do get questions about it. Folks just trying to kind of pick our brain and see what we think about various things. Um, Probably the most common question that's macro in the more traditional sense is this one, and I think Rhett and I have both gotten this at various times over the past year, uh, more specifically or more recently than not. When's the crash coming? Everyone, or a lot of folks, seem to feel, if nothing else, that well, because where the market has gone over the last 5 years, can cite a number of fairly technical arguments. Technical meaning based on just sort of price behavior in the market. We've never had a sustained rise for this long since X date, and in month 7 after that point, then it's always 3 times out of 4 gone down. But we don't really pay much attention to any of that. Again, it is a valid question, not to discount it all. The point is, number one, nobody really knows, considering us. But the way that we think about when a crash might be coming is really rooted in sort of a rational view of things in general, and specifically with regards to the valuation of the markets, as it were. So, this is really all I'm going to spend on macro this year. Talk a little bit about valuation in general. This is a snapshot again through that Labor Day weekend earlier this year. Just gives you kind of a short-term view, ST's short-term view of how overvalued the market is in the grand scheme of things. Right now, it's not necessarily out of whack. Again, this is a little bit dated, but it certainly has been more overvalued in the recent and not too distant past. It's a little bit of an anomaly. It's certainly harder for me, for instance, to find really good companies that are trading for really cheap. It's a completely different environment as far as looking at new companies than it was a year ago, 4 years ago for sure. Not to say there aren't values out there, but you've got a company like Fiat, for instance, which could be a two and a half, three bagger over the next 5 years, really. That seems, as you peel back the onion, shockingly cheap. And then out there you've got sort of the Teslas of the world and a lot of quick service restaurants that have recently IPO'd that seem to be trading at crazy unsustainable valuation. So, it's a little bit of an anomaly, and it's a little bit of an odd thing to see some things that are ridiculously, obviously overvalued, and other things, the kind of things that you might find in Tarpon, for instance, that seem pretty demonstrably undervalued. So, all in all, that's probably I guess, a reasonably healthy thing if you're going to have a handful of very expensive companies to still find some that are very cheap. On a sort of a longer term basis, again, at right, you can see where the market is in terms of one back of the envelope approach to trying to put a value on it compared to where things were back in 03, 04, 05. So, things are modestly overvalued at this point. They're not really at a level that is immediately concerning to me. I think the next obvious question is, all right, well, what happens if we get to that level, or what will happen then? And my answer would be, well, we'll play it by ear. We'll adjust and see what happens as things go on. Right now in Tarpon, we've got about 7% cash. There are some very well-known value investors who are at 30% cash, 40. But it's just a different sort of mindset, different philosophies. I'm not trying to make a market directional call with cash levels in the portfolio. That's just the result of sort of the normal process, and that just happens to be the outcome. We have been, we meaning the market in general, again, as you can tell by this overview, has been significantly more overvalued than it is right now. And it's just where things are, not trying to read too much in the tea leaves one or the other. But excuse me, it does certainly underscore why it's harder to find really good, really cheap companies. And the challenge for a portfolio manager, I think, is to avoid kind of compromising on the quality of the company just to get something that's demonstrably cheap. So that's more than anything what I try to keep in the back of my mind as I'm looking at new prospects every day or every week. It can be even hard to update the watch list for weeks in a row here with things that might be potentially attractive. Things to keep an eye on. This is the U.S. version, so this is just my take on it. I spent a lot of time last year at the annual meeting, hopefully not scaring people too much, but talking about sort of the implied or implicit threat that was in bonds related to rising interest rates. I'm just sort of going to quickly kind of lump all these together and tell you, obviously, interest rates is of concern for both me and a lot of other people, based on a lot of the same reasons I talked sort of in detail about last year. They all tie together, though. Interest rates, inflation, the unwinding of QE, the unwinding of quantitative easing. Probably a whole another discussion to have at some point about Chairwoman Yellen's plans for reverse repos and how exactly we're going to unwind our way out of the great experiment that quantitative easing has been. Too much of a probably a broad discussion to include here. All of that I'd summarize and say, all right, well, obviously bonds are going to be still at risk like they were last year. They make me particularly nervous, and that will probably factor more to some of the total portfolio management services that we're going to provide once Hunter comes on board. So, bonds in general, something I'm very wary of, and we will see. Take it as it comes in terms of how interest rates start to rise, and just kind of keep an eye on things.
So just some things to keep an eye on in the international market are changes in currencies, fluctuating currencies, which impact reported earnings and also your investment itself. The outlook for global growth, and of course the political unrest. For instance, what's going on in Thailand right now, Putin's forage into the Ukraine, and also what's going on around China. We can't really impact that latter thing to consider, but it's something to monitor. Just as an example here, this is a chart showing how the currencies have behaved. This is the euro versus the Brazilian real versus the ruble and versus the US dollar. So they have been fluctuating. This does create some uncertainty for companies. Many are saying that outside of the ruble, there's some stabilization going on within this area. So hopefully it won't be as much of a problem in the future, but again, something to watch out for. This is I typically like to look at the World Bank as what their estimates are for estimated GDP growth. They're usually wrong. They usually overstate GDP growth, but it is nice to see that we are expecting that there will be some growth coming out of most of the economies around the world. It looks like, again, like the developed markets are the ones that are going to be leading growth, although we do have some improvement in what are known as the high income companies, which are the more developed markets like the US and Europe. So again, there's things to consider as far as what's going on in the global economy, but there's also lots of opportunities right now. And of course, as investors, that's what we like to see.
Okay, that's it. I know we threw a lot at everybody, both at the annual meeting and in this slideshow again. If anybody has questions, by all means, please feel free, either call or email, whatever you are curious about. Be happy to respond that way. Um, Hope this was useful and somewhat educational for you. Apologies if I went down the rabbit hole too much on certain geeky parts of it, but it's kind of comes with the territory, I guess. Thank you for your attention. Again, please let me know if you have questions. And if you couldn't make it to the meeting this past May, hope you can make it next year. Thanks.